talk today about some technical analysis about the stock market. As we know, the stock has been going always like this. It's been going up, down, up, down. Sometimes go higher and go down. It's go down and it's move lower. So whenever you buy, you always buy at the bottom. You buy back here. So therefore, when you buy here. And you wait for the stock to move higher. You buy, you can sell here. And then we do what we call you buy whenever the stock is going back down. You can either buy back here again. All those points here, we call them buy. You always buy at the lowest point. And as I've been told you all the time, you got to always buy when the stock is go lower. So the lowest it goes, you buy more. Let's say, for instance, if you have used your like $100 there, we do that. People that invest for long term. If you have bought for 100 there, and then when this stock is going back down here, for instance, if it's going like we call that back here is low, but this low is lowest than this one. So if you want to accumulate, if you want to add more some money, now you cannot add $100 from there because this one is a lower high. So this one is higher than this previous low. So therefore, you're gonna add maybe $75. And then because you accumulate. And then when stock go in there, if you want to sell, we sell, get some money. But if you do it for long term, you don't worry about it. You don't have to sell. You wait again for the stock. You don't keep buy when it get higher. Now you wait for the stock to go back down. Now, for instance, if it goes to the same level, as you can see, this one is the same level, we can add another $75. And then it goes back higher now, you see? High. We call it higher. Now it goes higher. If you want to sell, get some money, you do it. But if you invest for the long term, so therefore you can leave your money. If it's go low there, if you don't want to add some money, you can just put anything here because it's a higher low. So the stock move again back there at the same level. Now, if it's go lower, as you can see there, it's go low. So it's go lower, same level like this one. Now again, you can add another $100. That's the way, especially when you invest for long term. And also, start maybe go there here, and then it's go lower, for instance. Now, as you can see there, it's been going lower. That's called lower low. It's going lower than the previous low, this one. Remember, you start buying at $100 from there, but now it goes lower than the previous one that you bought. So therefore now, instead of buy for $100 now, you're gonna buy more because the lowest it goes, you add more money. For instance, you can buy for 150 now. You see that? You add more money, the lowest the stock goes. I'm gonna erase and then we're gonna do something almost the same thing again. I'm gonna teach you the better way again. Let's go move. Yep. So by the way, if you want, you can go to my website. If you want to get the class, we have a class especially for people that start trading for beginners. We offer a class like $100 for people that need to know about TradingView. We teach you all the tools there, how to use TradingView. For therefore, so if you want to use TradingView, you just use the link down there, and then you're gonna get the class. I teach you step by step how to use the tool. I'm gonna show you TradingView platform later so you can see. And also we teach you about candlestick. If you're gonna learn how to trade, you got to know what those candlestick mean. And we teach you step by step how to use those candlestick and what do they mean. Just click on the link down there. And also if you want to purchase the TradingView app or the platform, we put a link for you. It's only $15. It's only 15 discount. It's like $15 discount. With my link, you're gonna get a 15% discount. And just click on there and use it. All right. Or you can call it dollar cost average. Let's say that we're gonna do what you call a dollar. We're gonna call that dollar cost average. This is what we call dollar cost average for people that's been investing for long term. So when you do dollar cost average, especially when you buy strong stock, like let's say people stock like Apple, those are the strong stock like MSFT, Microsoft, stock like Meta, etc. So let's say those stock there, when you buy them for long term, we call those stocks like monopoly stock. So this those stocks that they can hold themselves. So meaning the stocks are very strong. So when you buy the stock, or let's say if you buy like SPS, SP 500, let's say you buy SP 500, all big strong things. Now, whenever stock is going down, let's say that you buy from there, how did dollar cost average work? For instance, you can buy a fixed amount of money regardless of the stock price. You can buy a fixed amount, or you can do what you call a buy the dip, or you can do what you call a average down. So we can do a buy the dip, or we can do what you call a average down. We can do three things. We can do first, we can do dollar cost average. we can do a buy the dip. And thirdly, we can do what you call averaging down, or almost the same. With the dollar cost average, we do what we call it for the dollar cost average itself. We do what you call you do a fixed amount. For instance, for the dollar cost average, if you gonna use, like instance, you're gonna invest $100 every month, or every 2 months, or every week, you use $100 every time they start going, either is going up or down, up or down, up, down. You use one fixed amount. You do a fixed amount of that. The one fixed amount. We do one fixed amount. We call that dollar cost average. We got this of the stock price often buying more share when the price is low and fewer when it's high. So you can do, for instance, either two. You can do whenever the stock going higher, you buy more money, or if it's go lower, you buy more money. If it's go higher, you buy less money. For instance, you can do, you buy here at $100, and if you want to do here, you still want to buy here, you can buy $50, and it goes down to that level, you can buy $75, and start moving higher here. If you still, because that's a long term, and remember, you buy what you call big strong stock, you can still buy $25 here if you want to. It doesn't matter. And then wherever the limit or the price, whatever the prices goes, you can buy if you want to. But you don't have to do that. Most people use that strategy. They use average down, because the lowest it goes, they buy more. But when you use dollar cost average, you can do that the same too. So that's why I told you all of them are similar, the same thing, but they have different meaning. And average, and when you do average down, that's mean you're buying more share of a stock you already own as its price decrease. It's the same thing. So when the prices decrease, for instance, if this stock, for instance, let's say Apple stock prices, let's say the price is $230. Let's say Apple stock price is at $230. And when Apple goes lower, for instance, it goes to 200, you add more share. And then when the price from 230 goes to 200 and it moves lower to 180 of share, Apple share goes to 180, you add more share. You buy for more. And when price go lower, for instance, the price go at $100, share, you buy more share. We call that average down. But what is best about, either way, you have to do your average down. You have to add more share, or you buy for more money. You add either way, you buy add more shares, or you buy for money, or add more money. You buy for more money when they start going lower. For instance, here you start at $100. That's your start point. You buy $100, and start moving higher there. You can buy 50. But if you don't do that, you wait for the stock go lower than the previous low, as I've been told you in the previous shot. And for instance, that's a line. Stock, it will be going lower. You can say, let me buy for $120. Remember, when you start buying, you buy here at $100. Now, when it goes to that level, you can say, let me buy to 120. And from there, start moving high. You leave it, you let it go high. It doesn't matter. And it goes lower than the previous. We call that lower low. So it goes lower than the previous low. So there, you buy for 100, and there you buy 120. From here now, you can buy, say you buy 135. You use $135 for them because it goes lower than those two previous low. So whenever stock moving lower, this time you buy more share. And then now stock moving go there, you don't worry about it. But if you do like average down or you do fix, you do dollar cost average, you can still buy some here. You can still buy here, but you don't buy that much. But if you don't want to, you do what you call average down. So you let it go lower. So now stock been going sideways here. You don't, you just not worry about it. It's go high and you let it come down. Now it goes back down here to the same level from there. You can buy, when you buy 100, you can add 100 there again. Or if you want, you can add less, 75. And you let it go and you go a little bit higher here. It go higher than this one. So stock moving back down is go lower than those previous three, all those previous low. That's mean lower, low, lower, low. So that's mean it's go lower than those previous one, all those previous. So now, remember you bought 100, you bought 125, there you bought 135. Now, since it goes lower than those previous, you can buy 150. So the lowest it goes, you add more money. That's what you call dollar cost average. And you can do average down or fixed amount. So in those three things, you do what you call, when you invest your money, we can do what you call dollar cost. When you do dollar cost average, when you invest your money for long term, you can do those three things, but they are the same similar time. You can do dollar cost average. We can do what you call average down. And you can do what you call buy the dip. You can do those three things when you buy for long term will be good. By the way, don't forget, if you like this video, just do me a favor, please subscribe, like, and share, comment. If you need anything to be covered, just let me know in the comment. Any question, anything that you need, just let me know. Just forget, subscribe so we can add and push more video for you. So you do what you call dollar cost average, average down, buy the dip. So stock is moving, you buy. Example again. Stock open here. You buy $100 here, and it's moved high. It goes lower than the previous here. You buy for more. You buy 125. You can do here average down or average cost dollar cost average, and start moving back highest and go like this away, and then it goes there and go there, and then it goes lower. You buy more. It goes lower than those two previous one. You bought here 100. You buy here 125. Now you can buy more. You can buy 150 and start moving high. Go high, go high, go high, and go lower than those two previous. Then you buy 175. So that means the lower the stock goes, you add more money. Or you can do good dollar cost average too. You can buy this, and here you buy less. You go there, you buy more. Here, if you want to still buy, you buy less than this. And then when you go back there, you buy more than this. When it goes there, you buy less than this and then this. And then when it goes back lower than those twos, all those three previous, you buy more money. That's the way you do dollar cost average, or you do buying the dip or average down. So especially when you invest for long term, we're talking about here long term. And not only that, when you buy what you call great company. when this company are very strong company, they have to be very strong, or call that monopoly company, that can hold themselves. You do what you call dollar cost average. You do what's called dollar cost average, or you can do average down, or you do buy and tip. So that now, at the end of all those down, average down, everything, and then you buy all those deep down, all those, and then when the stock is moving higher, you make big money. That's the way you invest money. Now you make big money. You can cash out, you can take some money. Because I always told you, by putting your money in a bank will not give you nothing. Your money will stay flat. Money stay flat because bank itself does not give you money. The bank itself, what they do the same thing that you did. They take your money, your own money, yours, and they invest it buying the dip. They do dollar cost average. They buy the dip. They do dollar cost average, and also they do average down. They use your money to buy shares, to invest. The bank use your own money themselves. The bank use your money to invest. That's why when you go to the bank, you don't have money. The money is not there because they invest your money. And that's why you can put $100,000, you can put $200,000, you can put $100,000, you can put $50,000. Your money has been invested in the bank. And you don't have money there because what they do with your money, they invest. You make the bank make money by loading your money there, by leaving your money for 1, 2, 3, 4, 5, 6, 7 years. You leave this money there, they get rich and richer because your money make them get rich. So why don't you take your own money and you do what for yourself? You do dollar cost average. You do average down. You do buy the dip yourself. And then your money now will go going up instead of leaving them at the back. So that's his way. My friend, if you like it, just do me a favor, subscribe, like, and share. It was Harry. So see you. It was a pleasure to be with you. Don't forget to do that. Thank you. Please do that. Go to my website, www.ryfastores.com. We have those classes there. Click on the 5-day bootcamp to get those classes for TradingView and also for the candlestick, and use my link down to purchase the TradingView app with a 15% discount. So thank you for being there. See you in the next video. Click on the subscribe and like so we can come up with a good video for you. It was here. We take care. Bye bye. See you. Keep in touch.